Here we go. Happy birthday.
Alright guys, welcome to the stream. It's Wednesday. Oh my god, that's hot micing. There. Alright, how's everybody doing today? We got the new Twitch channel up, got the new YouTube channel up. We're gonna be looking at some markets today, discussing some things in Discord. A couple of disclaimers. This is not trading advice, it's not financial advice. I'm not a financial advisor. For trading stuff, you kind of have to make your own decisions. Let's take a look-see. Let's go over a couple of things here. Alright, so a couple of Mints, thanks for the follow. Went 12k. A couple of resources for you guys. All of the tools that I use are going to be available on the BAPig indicator. All the links are in the description for the referrals. If you guys use those, I would very much appreciate them. You can join our Discord here, and there's a link for that in the description of the videos and the streams as well. All of the fantastic indicators and packages can be found on the indicators page, so take a look there. A couple more resources for you guys. Brilliant is a fantastic website to learn new math concepts, new finance concepts. They have a lot of info there, a lot of things for you to do, and it's relatively inexpensive actually. So most of the math things that the tools are programmed with the concepts behind them are going to be found here, and you guys are going to be better able to understand what kind of assumptions you can make and what kind of assumptions you probably shouldn't make. Market Chameleon is a great free tool to see IV ranks of stocks, to rank order them. Let's see. There's actually quite a lot of resources here. I think it's all free. They do have some premium features as well, which you can try out for picking your stocks. You can rank them by IV, and this will help you better understand the pricing behind them. Are options expensive on them? Are options cheap on them right now? What kind of moves we can expect, and so on. The other great resource is Tasty Trade. I personally started on Tasty Trade. When we were looking at using math, and that's the alarm for the market open. When we were looking at the market to begin with, like the math concepts weren't there at all, and what helped me get introduced to those concepts was the Skinny on Options Math playlist with Jacob. Not everything he says is going to be correct, but it's a great starting point. It's very easy to digest. They kind of got the concepts broken down into individual videos here, so I would highly recommend you check that out as well. Alright, and let's get into the stream here. Alright, let me just take the music down a notch. Let's get the Discord volume up. What's up, Bolly? Alright guys, welcome. So let's start with a little bit of a market overview here.
The mic was muted.
Yeah, no worries. Yeah, you're kind of hot micing there. I don't know if you can turn it down a little bit. Can hear myself. Alright, let's start with the market overview. I want to take a look at the indices to begin with, to see how they were trading. Last time we were on here, we saw some of the markets really take a poo-poo. it was pretty bad. So Germany looks like pulled up a little bit off the lows. RTS is a Russian index. It's actually looking relatively strong. You do have some trend going on here, picking back up, so that actually looks pretty good. MOEX, also Russia, trend declining, but the market's not looking too bad. Let's see, UK had a big day up. It's now going above the POV mean. So that would imply that it's going to go bullish if it settles the day above there. It's going to be an interesting one to watch. China was looking the worst out of all of them. It also pulled up off the lows. We can see trend's actually still rising here. It's still negative. Entropy went down a little bit, so this is still in kind of a bearish stance here. Not looking too good for China. Do I have the Hang Seng? Yeah. This is the Hong Kong index. Entropy is now moving down. Trend is still moving up, although it's giving you some indication that it's trying to slow down in trend. All right. What else can we see? It's negative across the board here. I should actually pull up some volatility indicators on this chart as well. Let's take a look. See, I want to delete that.
Did you have the new entropy, or were you showing the?
Yeah, this is the Entropy Pro. This is the new Entropy. Oh yeah, guys, I got set up with a bunch of new tools, so it's gonna look a lot different than the last stream. Hopefully, this will be much closer to what you guys have, and we'll be able to go over the concepts more in depth and show off some of the awesome features that these guys have been working on like crazy. HVP. Yeah, so volatility is still picking up here. I actually want to adjust the settings on this thing. 3365. Since we're looking on daily, just a little bit more long-term context here. There's a bit of a rise here. All right, let's take a look at Japan. Japan's still looking strong. Yeah, I think it was looking the strongest out of all of them. The positive trend is moving down, but it's definitely not over. It's right on the mean of the POV. So if I were to be a betting man, this is kind of where I would want to onboard, and kind of easy to manage for myself, just to close below it. I would start looking for bearish trades there. But there are a few things that's saying that the trend's coming to an end here. You know, drift is lowering, the entropy's moving up. So yeah, I'd be careful with this one, but it doesn't look bad at all. Let's take a look at the Nikkei. Very similar to Japan, makes sense, which Nikkei is just the Japanese index. Also very similar in trend quality. It does have rising volatility off a very low point, so I'd be curious to see next 120, 160 days to see how that develops. That should be an interesting one. Let's take a look at Dow Jones, which is the Americans now. Let the tools load in. The American indices were looking quite poor to start the week. They were getting a little bit more volatile. So we saw the moves down in NASDAQ, S&P 500, and now they seem to be coming off the lows. Volatility is still worrying here, just because it is so low. So I would expect over the long term, next 3 months or so, for it to expand. It doesn't have to, but that's just kind of the way I structure my trades, especially if I'm looking for delta. I go off of low HVP, and I'm looking forward to going to high HVP. Let's see, the quality of trend is decreasing from the downside. which was kind of, getting us worried on the indices at the start of the week, last week, when we saw the trend getting quite aggressive there. Entropy's now moving off, so I would personally say we probably get some nonsense here since entropy's not that low. We probably move up to the POV mean, kind of bounce around there. But again, price is random. It doesn't have to do anything I say. It's just kind of how I'm looking at the market and the assumptions that I'm making. Trend quality is decreasing, which to me is interesting, but I wouldn't want to take long trades personally until we beat that midline or we see some positive trend developing. Yeah, let's take a look at the S&P 500. Also now backing off the lows. Yesterday was a very scary day with a very scary close. Let's actually take a look at the trend quality. Trend quality is still quite worrying here. It looks like it's expanding to the downside trend. Variance still moving up. Volatility still moving up.
Vlad, which mode do you have it on? I think it's on the default with the the TQC.
So
which mode is it?
I think I have it on the default.
Okay.
Price among munching.
Yeah. So just the idea is that it looks at if two metrics of variability are correlated, then it's you can say, it's not the trend in the correlation or out of correlation. It's just a correlation between two variabilities, and people just, I was gonna say, this is with mom, so mom inside of it has like expected move, so it's like a bit abstract. But if you look at the, I don't know, something simpler like price in this mean or whatever, one of the most, we can talk about it later, but
yeah, okay, let's actually dive into the TQC because I haven't had much experience in using this indicator, and the way I was gauging it, it was just for trend purposes, right? Like, is the downside trend, like, I was assuming that...
The reason I say that is because Marky complained about this, because I updated it, and then Marky was complaining about it, so I'm not sure, like, the problem was, so that's what, right, Marky? Let me ask.
Gotcha. When was the update?
The day that, like, I released, maybe a day after that, there was something that I changed, and then he and there was like multiple updates in like in a short time. So then he was stuck with one of them, and he enjoyed that one better. Later he told me, it was like, yo, you.
Gotcha.
But he found something, and because I added like that feature, but like I took something away, assuming no one was using it. So I'm not sure if the default he was complaining about, or what was default before the update.
Right, that makes sense. All right, let's take a look at NASDAQ.
Now, so I probably fixed it, or so maybe there was a setting. He's saying it's good now. Yeah.
He's saying it's good now. Okay. NASDAQ very similar to SPY on the metrics as well. Entropy is very high, so I would expect some randomness here. Volatility is very low, so I would kind of keep an eye on that. Hey, thanks for the follow, Scalus91. So I would be very cautious about this low in volatility. Let's take a look at some currencies, and then we'll move over to Bitcoin as well. Oh, actually, one thing I wanted to check out was rates. Yesterday we saw a slight move down. I think the 2-month moved down a little bit more, but virtually no change. There's nothing interesting going on here at the moment. So things will, like TLT, they'll probably just be flat. We can actually take a look on this screen, TLT. Yeah, TLT is looking flat. You got some cool in volatility here. You do have a yellow flash in the PEP here, which is suggesting to you that you're actually going to get a move down in entropy. You can see some past examples of this. The signal itself, or not the signal, I guess, but The thing that you should look for when you're getting yellow flashes is you're gonna get this blue kind of continuation down, and that will hopefully give you an expansion, or sorry, a decrease in your entropy, which
The
is
yellow is only saying there was no change in the value of the So the red is when it's going up, blue is when it's going down, and yellow when there's no change.
when there's no
And
change.
when there's no change, like you can see sometimes change doesn't mean, when there's no change, it doesn't mean like now it's going to be a reversal, but it's sort of because this is a percentile thing. It's sort of looking at the volatility, HVP versus. So like sometimes when you look at HVP, you don't know the context of actual volatility. But if there was a thing it usually isn't a problem, because like if you line it up with the entropy that Luke has, this Kaufman coded or whatever, it works fine. But by itself, if you want to use it, maybe it would be better if it actually shows you the entropy too.
Right.
That's the percentile of entropy, right?
Yeah. So what Bali's kind of mentioning here is that you know, this red denotes a rise in entropy, so that's kind of where you are. Then yellow would just be flat, so you'd be kind of here. It doesn't have to go down to the blue. If it does, the blue will start flashing. It could continue to go up into red, right? And so you should be aware of that. But yellow is sort of telling you just hey, you might want to watch this going forward.
You know the value matters, right? So if it's like 95 and it's going to go right because it's percentile. Right. It has a benefit.
All right, let's take a look at some currencies, and then we'll move on to gold and Bitcoin. US dollar actually looking pretty good. This is US dollar index, which is very, very similar to US dollar euro, because I think 60% of this basket is just euro. Something like that. It's mostly weighted in euro. Volatility is low. You got the PEP moving up. What else is there? We'll go over the TQC later and what it signifies. POP, from what I understand, is another metric of entropy. Is that correct?
What was that, bro?
POP is just another metric of entropy.
POP is portion of price. Mm-hmm. Portion is just the value of the thing divided by the sum of like the value divided by sum of some length. So it's like, but then portion of price. Oh, you're right. You're 100% right. So is that in the description? Because I don't remember. Did I tell you that?
Yeah, I was reading the description this morning.
Yeah. Oh, so I mentioned it. Okay. Rare, but I was going to say, like, for example, like TQC, each mode, like it's better if I explained it, and then like if people knew what mom was, then they would get it. But these are, because they're so different than the other old stuff, that they're easier to explain. So I didn't know that was there. So yeah, the thing about when people do entropy, even in Python libraries, they do it wrong. They just do the part that is x log x, correct? But then the PIs need to be like probabilities and need to add up to. So it's not like, but if you did the entropy of the portion of price, which is again another like measure of variability. Another great thing about that thing is like without adding parameters, x log x follows the price. So you're not adding anything, but yet it's measuring variability, and it will like track the price. So then if you have you check its correlation squared, it's pretty good for it's two things. You just have to remember it's not entropy,
right?
It's entropy of the function of price.
So I was actually trying to backtest this indicator earlier today, and like the way I was kind of looking at it, I might be totally wrong. Correct me if I'm wrong here. But when you're having a rise in green and you're above the some sort of mean in, I know there isn't a mean in price, but like let's say we're just using the POV mean.
You're not right. I was just gonna say, like the reason those don't have descriptions is because it really is if you pictorially see it, that's good enough. You don't
Yeah,
need to
so
like
that's kind of
you
like how I was looking at it.
know, yeah, but if you get into like, oh, this entropy is not agreed,
Yeah, like
so like,
even like looking at these two zones, like you can see it's below the POV,
yeah,
and it's increasing, 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 and then over here it's calling a decrease in
it's
entropy
talking
with
about
R squared, right? So this is kind of like the area you might want to take some positions off if you were betting short here, and this is the area where you might want to take some positions off. And there's actually a
also
couple of
this has the same idea there, where like the dot is where the value of the thing changing from negative to positive. So it's like that's an
okay.
actionable.
That's like,
Yeah.
yeah, okay, I got you.
Like that tells you. I think I gotta confirm with the code, but I think it's that when it because the colors correlate with the price, right? The colors. So like
Right,
going up with it's showing. I think it's showing you the R squared, and then the colors coming from portion of price. But then like if these are not usually people really love the dot. I'm trying to find like what a good example. Like it gets you out because like if you go in on a in a thing that like you bet up and then the earliest is it tries to tell you as early as it can. So
right,
like it's there's more emphasis on it being fast than certain. So like
right.
that just keep that in mind.
That makes sense. Let's take a look at USD CAD, looking very similar to Dixie. Actually backed off the 2% cone. USD ruble. This one's just for me. Yeah, it's kind of trying to settle in below the POV there. There's virtually no trend from what I'm looking at here. Volatility is low and rising, so maybe it's time for me to buy some more rubles. Not a bad idea. Let's take a look at gold. Alright, what can we say about gold here? This is kind of calling for a lowering in entropy. It's now blue and declining. So we'll have to see, because it's below the POV, I would be looking at some short trades here for gold, unless we go above it. Let's take a look. Yeah, nothing on the pop, almost nothing on the drift. It's kind of flat. Um, Volatility is declining, so there's a good chance that nothing happens in gold for a little bit here. Unless you start to see, a rise in volatility here. Yeah, I just expect it to be a little bit boring here. Silver, you had this trend down for quite a while, very similar to gold now. The HVP is declining. What am I doing here? Move drawings. HVP is declining. It's kind of signaling that it's going to be boring for this little bit period of time, but I would be on the lookout for the next trade here. Let's take a look at the VIX. VIX was interesting yesterday, and the day before that opened on the gap up and then kind of sold off. I would still be worried about the VIX because you do have the pop moving up. You have the entropy moving down. Although the PEP, to be fair, is saying that it's not going to continue to move down right here, right now, so maybe we get some more randomness in the VIX, this kind of bounce around. You are trending bullish on the VIX here, though, so I would be careful. The VIX is a little bit tough though because for most of its time it's very flat to down. I mean that's why a lot of funds they go short the VIX. That's like their bread and butter trade. Kind of makes sense with things just slowly and steadily moving up, and then from time to time you have these Rona dump type things, but they're very far in between. They're a rare occurrence, let's say. Let's take a look at Bitcoin. All right, Bitcoin. It's actually on the POV. It's looking more and more bearish. On the pop, it's looking like the entropy is going to be declining, which would be good for a downside trade here. It is below the mean, so I'd be kind of worried about that. You have volatility now rising. There's actually negative correlation with price on it as well. We know that correlation's a little bit slow. It's a little bit inaccurate, maybe, let's say. Maybe not inaccurate. It's very slow, and you could make an argument that it doesn't matter. Is that right, Bali? Like what would you say about correlation with the HVP versus price?
Oh, generally, okay. So the initial idea. So there's a bunch of problems with just alone. Doesn't matter with what, but like with HVP and correlation, the idea was that because the volatility trend's cleaner, but with correlation you have two variables, and the two you assume are like if me and you have a relationship, what does that depend on? It doesn't depend on one of us. It depends on both of us.
You're
So
right.
like when HVP gets to its 100 and 0, because it can only go one way, at those two scenarios, on one side you only have one outcome. So then if you know the correlation and you can make an assumption whether depending on what the correlation is doing at the time, then you can make an assumption on the other because you're eliminating one of the variables.
Right.
So that was the idea. But like generally, if you the correlation with the volatility and the HVP or any volatility price, the volatility. If you trade in delta, you want the volatility. So whether it's positive, like the R square needs to increase. So whether it's positive, so you're looking for absolute value of correlation increasing. And for those things, it's better to like look at Z scores of it or whatever. But like the whole thing is that correlation it's what's going on now, and it's just a linear. Like the relationship is not linear. This is just observing it in a linear manner, and it's just telling you what's going on now. Nothing about what's going on right the moment after or probabilities.
Right.
So, and the other problem with correlation is that it has the things. Your extremes are your extremes are like now appear more extreme than they are because you square the distance from the mean. So if you have a bunch of regular data and then one of us is out of a range, that is now like gets squared. So that's why like Taleb is anti standard deviation, anything that has a square in it. It's sort of like it would get, if you just looked at it, you would get the wrong idea.
Right.
Right. How do you know the square root of the thing that's telling you? And it's sort of diluted with the rest of it. So anyway, but like in general, that's fine. And we have a fix, and that's mutual information. That's coming. And the other thing I was going to say, Flat, maybe remember you looked at the omega ratio the other day?
Yeah.
Like you were surprised by the thing. Maybe you can show that too.
Yeah, absolutely. So one of the things actually that I was trying to decide yesterday was I currently have trades on in the traditional stock market, but I was looking, at the crypto list, and I was getting a little bit antsy to move into the crypto space because the traditional moved like 2%, and that was like a massive move for me. And here you have things moving 11% in a day, 4-6%. It's just the volatility is so much higher that I kind of so I was talking to Bali about it, and he was suggesting that I use the omega ratio to try and figure out whether or not something might be better from like if an instrument might be better from a volatility perspective, from basically how much of a return can I make on it versus another instrument. Let's take a look.
So that's what we have to care about. The reason we use that is because you want risk-adjusted returns, because like obviously something that's more volatile is going to have, if it goes your way, your returns, you're going to like it, but then it can also go the other way. So you want risk-adjusted, but then if you just go by Sharpe, it's returns divided by the standard deviation. So when it's in the denominator, the volatility sharps goes up. But then you don't want that. You don't want something that has lower than like where you're getting returns from. So
Right.
what you should look at is the probability distribution. So you look at what omega ratio tells you is the probability of between two assets, which one has a higher probability of larger ratio of gains to losses, and that's what you want.
And so for this one, I got quite confused yesterday because I'm currently on the Bitcoin chart, right?
Hold on a second. That went to my own. Oh yes. Okay. So yeah. No, you don't. I was explaining this. When we made it, the idea wasn't for you to. You don't need to like type in the settings. You need to focus on like changing the ticker. The settings. The idea is that like because any returns metric gotta have a benchmark. Like how do you know what returns are good? So when you go, which is like how are the pair? You have to then give it like bounds. So that we already like assume and give like because it's just it just tells you whether it's like if you look at the thing even you only care about the shape and the slope and you don't really care about the values. So
Right.
if it's above or below it. So so if you make an assumption that like your high risk one is Bitcoin and the other one is like SPY, you can just change the ticker on your chart and then this will compare it to the SPY. So like what are you on right now?
I'm
Bitcoin?
currently
Yeah.
on
So like for
Bitcoin.
example, so it's showing right now. It's showing you Bitcoin versus SPY, right?
Let's take a
The
look.
Omega rate.
Yeah, so right now it's showing me the SPY versus Bitcoin. Yeah, that's right.
Yeah. So look at Bitcoin. That's insane. How much better it is.
Yeah.
So that like in the x-axis, it's telling you like that's the returns. Those are the positive returns, and then it's that curve is on the y-axis would be the odds of it. So like the omega, the actual omega value, not the odds, it's the odds of gains versus losses. So but like if you just look at the shit, like for example, go on Ethereum and like compare Ethereum to like Bitcoin, the delta is like more than Bitcoin to SPY. That's what I'm trying to show. Like also if you put like on it takes into account that the point is like sharp is what everyone uses and it misses a lot of points. So
Right.
it's easier to say what sharp does things is.
So the other point I think that you were making yesterday is that yeah, you're gonna have more of a probability to make positive returns, but you're also gonna have a bigger probability of making a negative return as well with something.
Yeah, the assumption is that you're long here. It's same as beta. So like when you go, I'm beta positive, I'm beta negative. Like if you're on a day of a dump, your benchmark could be dumping. When you say I'm beta positive, you're on the same assumptions, you're the same direction as the benchmark, but they assume the benchmark to be long.
Right.
So like
Right.
when the thing is dumping, the reason I brought it up was like I was looking at MicroStrategy's versus Bitcoin, and then MicroStrategy had a better that was sort of shocking me, and then so that has a higher odds of higher ratio of gains versus losses, and then if you want to long it, so I was like, hey, if I want to buy calls on Bitcoin, it's better if it's also way more liquid, and the odds are high. So, but then if you wanted to, I was saying if you want to buy puts, it would be the opposite because you want higher odds of
Success.
losses versus gains.
Right.
Yeah. So yeah. But I was saying it's the most likely. The whole thing is that we can tell you what's likely, but the outcome doesn't need to be what's most likely. So this gives you odds. Maybe it was like two different combos. So like this gives you odds, but maybe I was talking about Kelly with that. That like Kelly will optimally fuck you.
Yeah.
But then same here. It's the same concept. Like it's telling you, but I just talking about the losses there. short something, exactly like beta. So like every beta is assumed that you're long. So and beta is like stupid. It doesn't tell you, you know, it's just excess returns, excess percentage moves. So it doesn't tell you up or down. Or but like here, I'm saying when the higher probability of gains versus losses doesn't equal the negated isn't the negative the statement. So it's useless.
So the two things, or sorry, some of the things that you're taking into account here are the probability of returns and how high those returns are.
Yeah, it's the ratio of gains versus losses. Those are returns, and if it has a higher probability of having the ratio being higher.
Right.
Because you can have this, they can both have the same ratio, but then if one has a higher probability, you should choose that one. But then also you can just have a better ratio, and then higher probability. Like you can have you don't need to think about this part of it because the formula takes care of it. But you can have a case where the ratio is up. I mean, is high, but then the odds of it is low. And then you can have the other way where the odds, the odds of it, the ratio is higher, and then that does the math and tells you. But maybe I was talking about the sharp where it's like, you want returns come, but then this is also taking account to gains versus losses and you being long. So it's doing a bunch of math for you.
Gotcha. So yeah, if you're ever stuck in a position like me where you're trying to decide between two assets or multiple assets, this is a very, very useful tool.
This is also, I brought this up to Twitter people. Hey, invest in Bitcoin. And they go, it's the future amount, all that. If you showed them it's measurably a better investment, risk-adjusted, performance-wise, if you go by the odds of gains versus losses, so risk adjusted. Like, what's the argument not to do?
Right. Right.
Like if you can, it's better than the SPY. It's better than Nasdaq. It's better. Like for example, you can put Doji, and like Doji is gonna look at, you can compare things, and all you have to tell it is give me a risky one and give me a low risk one, and it tells you where you are.
Yeah, that's awesome too. I think it's.
Nobody even knows about it. It's yeah.
Does that come in the altogether package?
No, it's open and free, and it's open source. We won awards for it, but most people don't even know it. How many people even do Sharp, and this is like you have to know Sharp is both. But like this answers people. You don't need to. It's not like a matter of opinion. This will tell. At least you're going by odds. It's not guaranteed, but you're going with what's likely. Like what.
All right, awesome. Let's take a look at Ethereum as well. Very, very similar to Bitcoin. You got rising volatility. You have a rise in entropy here, so no signal as of yet. You got a rise in TQC. Maybe we can go dive deeper into this one, especially in like Bitcoin. Because I'm using it for trend, but I only have half a day experience with it.
No, it's very powerful, and then I think it doesn't have ZMA, and I have to add ZMA. But like now that I know tools you're using, I know what to focus on to like fix. A lot of them need fixing.
Gotcha.
So we'll fix this, and then I can I can pull it up and have the code in front of me so I can talk about it. But like off the top of my head,
No, yeah, you're good. Just because I just wanted a general description of it, but we can always cover it in the next stream. And guys that are watching, you're gonna see us get some stuff wrong. We're gonna come back and correct it when we can, and yeah, we'll go from there. Just because these guys are coding all the time, they're bringing out new stuff all the time.
We're constantly in Discord, like
yeah.
I'm more accessible there than I am to my family. So
yeah. So come join us on Discord and ask questions. Be engaged. Yeah, we got a fantastic community of traders there. Let's see, what else did I want to take a look at today? So that's basically the market at a glance. I do want to go into some of the things that I'm going to be doing. I pulled some positions.
Sorry, you had a chart of moments. Was that? Did you get rid of that because of all this?
No, I have moments still up.
Maybe that's a good one to just like whatever you pull up, just like
Oh,
knowing the
that's true.
moments. You know,
That's actually very
we can
true.
make it into a thing where it's like a panel. Why not know it? Oh, you even have the next level. That's the chart that was. You didn't show that, but that's a good chart. So like I was saying.
Yeah, so let's actually dig deeper into Bitcoin because there are a lot of interesting things going on here. Moments is a fantastic free tool that analyzes returns. So if anybody is curious where we get the volatility metrics from, how we measure that, this is a great starting point because it'll actually be focused on returns and the curve in returns. So you do have on Bitcoin currently significant skewness. You did have significant kurtosis. That was, where was that? That was over here and declining over here. So that's pretty interesting. It doesn't give you necessarily like returns are not the same as price, right? And so when we talk about the curve of
Distribution. They say
it's the
you want to
yeah
know. Moments are like they have like gay expressions. Like moments are like moments in life. If you want to know,
maybe I can draw this up.
anyway, it's a description of the shape of any distribution. One way of knowing it is by its moments, and the moments are more inherent to the. So, like if you have a read of something else, that's a secondary thing. Moments is like a property because the distribution has a shape. You're not adding anything to the shape. So, and then based on the shape, you can make assumptions. But it's like the descriptive of the distribution of here returns. But every distribution has a shape, and one way of measuring is moments.
So this is what like maybe I should draw them one at a time. Well, so this is what
Yeah,
like a distribution curve would
the
look like.
first moment is the mean, and then the variance, and the skew, and the kurtosis. And then it's like
Exactly.
you have moment generating functions, and this is a normal one, and there's log normal.
So
And moment,
skewness
yeah.
tells you about like the shape of the curve, right? So like
But it's also about the good thing about this. Yeah, skew. The good thing about it is that it also tells you this. So if you are positive skew, you have you can bet if you're it's still you have to bet on a mean reversion or a trend. So if you have positive skew though, and you're long, like you can go on Investopedia and look at this. You want positive skew because then you get more frequent. Excuse me, less. It's more likely to get less frequent but more significant up moves. Because if you're long, you don't want the counter of it is more frequent, less significant down moves. And then
right,
whichever side the skew is, that's what's like more likely if it's not 50-50.
right.
So if long, you prefer it to be on the less frequent but more significant up moves.
Less frequent but more significant up moves. Got it. And
It's
then
like you have the log normal. You have the log normal because so you have this is normal
yeah,
effective value, and then it's log normal, and then you go if it's no skew, up and down, let's say, are equally likely, and down in a log normal just comes with just is how it is that it's more frequent but less significant, and the up moves are less frequent and more significant. And
right,
the way to like remember it is like with geometric returns, you just add one to the returns. So like if price doesn't go up a dollar, down a dollar, it goes up a percent, then down a percent. So you go if it's going up 10%, geometric returns would be like 1.1 up and then 0.9 down. So
right,
like because it can't go below, something can only drop 100%. So the minimum bound of it is zero. And then if you think of the market as a machine that generates random geometric returns, it spits them out, and then you go, oh, okay, so between 0 and 1, if your returns are between 0 and 1, price going down, because that price is multiplicative, and that multiplies to the price. And then if it's between 1 and infinity, it's going up. So like now, if this thing is spitting out, like you have these range between infinity and 0 to 1, and it's like if you were like, like just splashes of water on it, between 1 and 0 is more concentrated, right? If 50-50, it's going to land between these two areas. So between 0 and 1, it's going to be really concentrated, and it's going to be spread out between 1 and infinity. So because if you can picture that, then you can remember that the down moves are more frequent.
Well, you can,
because it has to be more dense, that area. Like if I had to spit out like rain at it, that like area between 0 and 1 would be really wet, and then 1 to infinity would get drops randomly so the parts that are really wet, happens more often.
So you can even probably just draw it out. Like if you're ever confused, there's some stuff we're gonna be getting a lot more tools in here. So like if you imagine like most of your returns are gonna be like scattered between 0 and 1, right? So you're gonna have
there's like this guy, what's his name? Tweed Brown Blue, whatever. Some math guy on YouTube. He was talking about how if people think about probabilities in areas, in form of areas, it's like easier for them to understand. That's why I've heard.
You're right. All right. So and kurtosis, where skewness is kind of like the distribution of the curve. The kurtosis is the tail of the curve. So when you have a fat tail, you have a much higher probability of having a more significant move. Is that correct?
Yeah, when the kurtosis is high, it's more likely to have get a move that goes to the tail, because the tail never the thing is that with the distributions, when you get away, like if you think of normal and then you get away from 3 standard deviations, go to like imagine a 6 or 7, that those the tails never touch the x-axis. So then like calculating the area there is very difficult, and it's very close to 0. It's not 0, but it's very close.
All right.
So that's why anything's possible, because like you have to go to infinity for that thing to close down to 0. So when the kurtosis is high, you're going to get moves that are going to be more like your distribution is more taily. So it's gonna, when kurtosis is increasing, that's when you should expect to have like a tail move.
Right. That makes sense. So you can see the kurtosis increasing here, and you see the skewness increasing here, and look at that, we got a massive down move over actually a prolonged period of time. So this is a fantastic free tool to measure returns, to give you some statistics on that. You should use it. You should absolutely use it. Especially when you pair it with other stuff like the volatility, HVP, it can become a powerful combination.
Entropy, because like entropy comes at a totally different angle.
Yeah.
And if you have this and entropy, you sort of have everything covered.
Exactly. The one thing that was getting me worried about Bitcoin as well, longer term, we were actually looking at the weekly yesterday. Let me take a look. It's weekly, Bitcoin. When you have 3 charts, by the way, make sure you're all on the same chart when when you're doing your work. Yesterday was a bit of an issue for me. From time to time, I was not on the right chart. And I'm gonna adjust the entropy here to a smaller period. I use something that makes sense for me. Like there isn't like a number that you should use, but I use 52 weeks because there's 52 weeks in a year. I use 365 days because there's 365 days in a year. And then I will use 4 weeks for the waiting period, because that's a month. All right, so what was getting me worried yesterday about this, we have a decline in volatility on a weekly basis, so we could stay here for quite a while, but potentially if we settle below the POV mean, I will be starting to look at short trades on Bitcoin to try and reduce my cost basis on it. Yeah, and you did have a pickup in trend. You have a bunch of things crossing their means. Um, on the mom you cross down, you still don't have the R square going negative. Sorry, that's probably not the right way to put it, but you don't have an end in correlation there between price and the mom in the background. Your regular mom is still just declining trend, hasn't crossed down yet below the midline. It's kind of looking shaky on the marks later, so I would really like to see where the 7-day closes, because we could potentially have uh, a moment of kind of below the mean of the POV trading, right? Or like we could go from the bullish stance to a bearish stance, essentially what I'm trying to say. So I'd be very careful with that. You have her still in significant trend, but I was looking at where the trend was starting for the Hearst. It looks like it's significant trend for the downside, and because like it started there and it's still in significant trend, right? So like I shouldn't even put that line there.
I have both, like the new Hearst. That's the way better. The with Hearst is that the value matters, but like this her simple is tradable. It's like, you know, maybe it's better because the whole idea is that do you want more certainty, or do you like when the value of this is saying whatever, and then 30 is telling you like, oh, something's gonna happen, like, so maybe I should just look at because I have both of them on, and the other one gives you more signal, but the signal is less
certain,
less statistically significant.
right?
But it's never the case that like that's gonna pick up something that this is, because this is a way closer estimate to the actual value. So and if you look at, like, if you put the average thing up, there's an MA inside you can just enable it in the settings. You can see that that's not like jagged, it's pretty smooth. So like it doesn't have like crazy reversals.
So to understand,
it's next to that 10. It says, what is it? If you come lower, no, it was the first. If you go to the last panel, yeah, and then it's next to that 10 number. You have to enable something. There's a box. You just have to, what does it say?
maybe I don't have it.
I don't know. I keep seeing it. Go back to inputs.
Yep.
And then it's I'm reading it now. You're in visibility, right? I go back to input, and then it says show filter length. Oh, it's 18. Excuse me. It is where it says show filter length. You just come lower. Yeah, right there. Now it has that. It's doing a MA now. That's like it's a what's the guy's name?
Okay, gotcha.
Filter, and it's a picture that just said MA, right? But he's just being very technical. So that's a filter, because Hearst is the slope of this linear regression that has like 10 best fitting points. There's 2 to the power. It's an insane thing. But so if you took an average of it, this is now, like, if you look at it, it doesn't have crazy reversals. It's like if simple is never going to give you a signal that this is missing, because this is more accurate of description of what's going on, and it doesn't have crazy moves. It's the slope of a linear. Like, it takes a lot for regression that is.
So if I were to say it in like a very simple way, could I say that it's the rate of change of the HVP?
Trading wise, you can say like that it moves as if that, but it literally is like it takes 10 points, and then it tells you how jagged it is, and then it's a measure of memory, but the way the guy came up with it, you first like calculate the fractal index, and then there's a thing that but it's
gotcha.
It's straight prices. So like that is, there's no, if how straight the price is, then you can like word it however you want. But it goes there is memory in it, or
Gotcha.
if it's too straight, if it fits like 10 points and it's a regression, the slope of the thing, if it's not 0, then there's some sort of memory there. So it's a very specific thing, my point. But like you can just observe it however you want, you know?
Right. Well, the reason I say that is because I'm trying to make an assumption out of it, and like the assumption I would have here is that if it's below the filter line and declining, I would be expecting the HVP to decline with it as long as it stays there. Is that a reasonable assumption?
So this is part of persistency. It's not the full persistency,
Right.
but all it's saying is that there is positive autocorrelation. Like if it's trend, there's positive autocorrelation, and if it's mean reversion, it's negative autocorrelation. But correlation, the absolute value matters. Like don't think that a move has to be a trend. If you look at it,
Right.
moves are mean reversions. So it's just like a term. For some reason, they're calling the negative mean reversion. I mean, it is mean reversion, but at least for myself, I had the trends. The absolute value matters. So, like I was gonna say, if you want to make, if you're just gonna go by, if it's not at half, it's either one. You care about it being, crossing half, and then is it going out of range to critical levels, or is it because it's out of range now going like within range? So it's end of the move, and then for that you can just like put like a oscillator on top to see. Because it's one is persistency in returns, one is variability in returns, right? Volatility. So persistency just means like if you're getting more positive returns, you're going to get more positive returns. If you're getting more negative returns, more when there's positive persistency.
Right.
With negative persistency, it's the opposite. So you're getting positive returns because now you have negative returns. So whichever is the case, is the thing, and then the other one is like is the variability involved in returns, which is did you say it's going to go? Actually, that makes sense because whether it's positive or negative autocorrelation, the sign of the thing doesn't change, right? But for volatility, it should change. If the sign of that thing is not changing, it could change. So it's not going on the way that the variability would go up, right? So like consistency. So for sure, if the sign of the thing doesn't change, then the volatility is going to drop. So yeah, correct. Yeah, but I never tell that. Russian.
Let's
no, but it's like that's what I keep saying though. Like if you're good at observing it, like for me to land there, I have to think about all these abstract concepts. Or you can just look at it and pick that up, and then go, oh, that makes sense. And that's just, right.
Well, yeah, that's what I was saying too yesterday. Is that like, yeah, I really just want something, to understand how to trade it more so to understand. Like you guys do all the math stuff and all the crazy like.
Get into details, because I'm just gonna like say it one time, and then just you don't need to remember the shit that I say. That is, it's like it's the slope of a linear regression, and it's the straightness, and then you're not gonna say nonsense. Like, enough progress, it's going to mean,
Hey, Kaushi, thanks for the follow. All right. So yeah, that's kind of what I was getting worried on the weekly. It does look like volatility is going to continue cooling off a little bit here on the weekly. That's going to take a while, right? Which is kind of in conflict with the daily. So I would take the daily for the short-term stuff, and I would keep an eye out on the weekly because it will be the daily that turns the weekly around, not the other way. All right, so like your lower time frame will start a move, and then it will continue on to the weekly time frame there. So I would be very careful in the shorter terms, and actually looking at the. What else was I looking at yesterday on the 7-day? Yeah, I was looking at the Marxilator yesterday. On the 7-day, I saw like the QMZ cross down. I saw the RMS cross down. It's not giving you any extremes. I think the QCV was actually attempting to point up here as well. QCV is another measure of variance from what I understand. It's kind of giving you, this is a non-directional tool, right? So like when it's going up, it's measuring the variances moving up. It's not measuring that your price is gonna be moving up. So that's why when you get crosses on these things, it can be a powerful setup for a directional trade or for a volatility trade. Let me actually adjust this once more. No, that's correct. That's correct. Yeah, so I would be careful there on the weekly. If that gives you a signal, I would take a look at it for sure. Let's go back to the daily. I wanted to look at the lower time frames as well on Bitcoin. 65 and 30. All right. Yeah, let's take a look at the lower time frames, the 4 hours. Give it a second to load in here. All right, so on the 4 hour, actually, Mom got it really, really well. Where you had a cross down, then you had some negative, and then you saw the correlation coming to an end here. Then you had confluence with the TQC as well, right? You had TQC moving down this whole time. You still have volatility rising. You had some extremes on the RMS percent, and I think, I'm not sure, maybe Mark, you can correct me if I'm wrong, but this is what he was looking at to gauge whether the immediate move was over or not. You had some more extremes over here. The one thing about the Mark oscillator that I find is that like extremes can get more extreme. So it's not like with the Mark oscillator, you kind of have to use confluence, right? Like you see the QCV still rising here, while QMZ score is giving you extremes, right? So I would wait. I would wait for this to give me a cross, or for something to go positive here. You know, like entropy, like above the MA, or sorry, not the MA, the POV MA. If I were to attempt a trade to the other side, let's say, I don't like just buying bottoms blindly unless I'm adding to a larger position. Like if I'm just trying to continuously add in a down market, then that's something that could work as a strategy. But if you're just trading, I would say you probably want to, use something else just to confirm.
Expected returns. If your expected returns, you have time for them, then that, right? If you want your returns quicker, then you gotta be more nimble to what the price is. It's just what it's like expected. When do you want your expected returns?
Right.
That's when you go like, oh, are you trading, or like do you want them sooner or later? If it's sooner, then you gotta not ignore it. If it's later, then you can.
And you actually had yeah, that's a good point. So like if you want your returns sooner, so for example, you want to take you want to snipe the bottom, you want to take a risk, and you want to trade it, I don't know, for example, to the midline. That would be an example of sooner. Or you want to or you want to, for example, do a trend trade to the other side, which would be an example, like if this line then curves up, if price moves up here, starts settling here, right, and you want to take this trade, that's an example of later returns. Do I have that correctly?
Also, yeah, you got it perfect. Also, a good proxy for what your expected return should be. It's not that valuable, but it's part of the formula. Is just look at the value of the mean. So like the first moment of the returns, you have the general thing that the best estimate of futures, but the best estimate of the future is like the current value. And
Right.
then, but for expected returns, you have the odds of the returns multiply the value of the mean multiplied by the number of the. But like just to have an idea, and if you have like a Bollinger on it like that, the value, whatever it is, that's what you should expect. And if you go 2 standard deviation away, that's 5% of the times you're gonna get that value, because majority of the time when people make trades, they don't even know they're expected if they're coming from TA world, but then they don't even know they're like
What kind of return you can expect.
If they understood what type of returns were reasonable to expect,
Yeah.
it would not like crazy leverage, crazy size, because if I told you, hey man,
Sorry, say that again.
if you were telling me like, oh, 3 standard deviations, and then I go like, hey, 3% of the time, odds are you're not going to do it. But like, if people thought of the odds of the move that they expect,
Yeah.
they would not stay out of a lot of dumb trades.
Right.
That's my point.
Right.
So
Gotcha.
like now, whatever the number is,
Yeah.
that's how much. And then if you want to understand how much in price that means, do geometric returns, add 1 to it.
Right. So yeah, like that's actually a good point. Like a lot of people, that's kind of where the doom and gloom comes from. It's like, we hear about Smintz, calling 12K for like the last 5 years. That's kind of
perfect way of telling them to shut the fuck up.
yeah, yeah, exactly. So
outside of there, then it's not happening.
Exactly.
If you had expected moves on,
yeah,
then you don't need to do this math of adding. Like that's what expected move is.
Right. Right. And hey, actually, let's go over what we can expect for the trading day on the expected moves. That's not a bad idea at all.
Also, the pro ones Laplace with asymmetric Laplace, and there's no way other assholes are making it can even do the optimization.
Let's take a look. See expected moves. Where did I have it?
There's 2. You go with the pro one.
Yeah.
Metric. It would be without the emoji. The one pro. Yeah, we're not fucking around.
All right.
Do you see it? Yeah, you got it.
Oh, it might be on not short side.
It goes with is it loading?
Yeah, it's just loading.
Multi-time frame enabled.
Yeah.
So like and then you can hide if you want the thing, hide it or extend it. Like if this is how I use. I hide the where it says hide. I enable that, and then I go extend, and then I don't look at the dots in the history. It just tells me what's going to happen next.
Gotcha.
Not what's going to happen next. The expected move.
Right. So for the moves today, we have 47,184, or let's say a little bit higher. I'm actually going to put these. So unexpected moves, the
15%. I think it's 15, 15, 5, 5, and 1, right? Because they're what was? Are you going by expected moves?
Yeah, I'm going by expected moves. Yeah.
Yeah, you can set that up to anything, but just I think it was 15, 15, 5, 5, and 1, 1. I think.
Right.
But you can set it to if you because we're conditioned to think in standard deviations, but any probability. So.
Right. So the expected move is trying to give you a price above which the probability would be to what you set it to, right? So like for example, for the third expected move, because it's 1-1, if today's price went above it, right? Like let's say the price is here.
Expected move is what happened. Cone is what's gonna happen. So
right.
The only difference is taking from the last close, and the other one's taking from the current price. So like, if you want to know the move that just happened, like how big was it, or like you go by expected move, and then for the future it's the cone. So like if you set it to now 1, and because it's asymmetric, we ask twice, because then you can have, if you set it to 2-1, it's going to look different depending on the side.
So 1-1, then the percent chance is 98%, right?
98% is covered. So
Yeah.
odds of price getting outside of it to each side is 1%.
Yeah.
But like the way these idiots do it is they go, oh, price got so you got to come back in. But price is not mean revert. If you have an expected move on returns and it does that, then fine. But expected move is like what just happened, and by itself really doesn't tell you anything. But if you have it with the cone, and you go like, okay, so from where I am now, what's gonna happen? So if you have the expected move, it tells you it's like this is what just happened, and then if you put the cone where you're at, then also if you just have your cone wasn't shit, it would show you that it's not gonna come back.
So for example, if I go to 0, right, or is it 1? It's probably 1. No, it's 0. Shit. Because see, I may have actually been using this incorrectly, because I thought, or I was under the impression that if today's bar goes above the 98% line, then it has 98% chance to close inside. Like I've structured trade on it, and like 2% of the time you're gonna be wrong. Is that an incorrect assumption? Oh, I think he's muted.
Oh, sorry, I was yelling at myself.
Yeah, no.
That's fine because the cone is set to the current price. That's why it's different. So it goes, if you put it back,
Yeah.
and then expected move has a thing that tells you, like if you set it, hey, projected 2 days forward, then it's exactly like the cone. So what the cone does, if you put it back to the current price, goes like anywhere you place the cone, the area that covers is correct. So that's so the area that covers is odds of it is the range of the cone.
Right.
So yeah, but like it every time the same probability gets tested. So like if you are going outside the cone, yes, it's to one side 1% likely, but then the next tick, now you're outside the cone. There's all this free area, and then like behind you there's the cone. Like it could go anywhere.
Right.
That's why yeah.
Yeah, that makes sense.
It's the thing that if you have 49 heads in a row, coin toss is still 50-50 because they're independent. From where it starts, that area is covered, but when it moves to a different place, you need a new area.
So I'd imagine that's a pretty difficult thing to gauge because, because I'm sure there are like individual stocks, for example, that will go. I know they're far and few in between, but that would go outside of that, right? Like.
Yeah, no, you can put it. You can go on a lower time frame and put it on a big move, and it gets. You can have 10 cones that like gets outside of it.
Right.
It's just like the numbers play out. Like if that's gonna happen, if it's like it's like getting odds of getting 18 heads, then of course on a lower time frame you're gonna see it because it's more occurrence.
Right.
On a daily you can see it. Like that's the thing. Like when I was this thing that we used to set it at like a certain percentage, like 99% or whatever.
Yeah.
The academics tell you can't really do that because you don't ever get that. Like there's no way you can measure that if you're correct or not, because the odds of that ever happening is low. That how do you know that the value that you have is correct? It's like if something is going to happen once every 10 years, and then I give you 10, within the 10 years I give you 10 values, you can't even like confirm that I'm right. Now it turns out like there's no reason for it to be wrong, but like you don't pass.
Mm-hmm.
But it still is it's not a piece of data you should just disregard.
Gotcha. All right, let's just take.
Also, if it occurs too many times, then you can if you go on a lower time frame to something that's supposed to happen 1% of the time, a 100% of the time, and then you get like 3 in a row. Then that range is clearly not working.
Hey, thanks for the follow, Aeon.
It's the same. You have the same problem. It's not a problem, but like you have the same thing in moments. that all these distributions, if they're not, these are only applying when they're not crazy, like they're not crazy.
Right, right.
When they have crazy things, then like you can have a variance, but if it doesn't converge on a zero on an infinite thing, it doesn't matter. It's like if you have a random set of numbers and then another random set of numbers, you know for. But if you measure the correlation is never going to tell you zero, like nothing. It's going to have a value,
Right.
and sometimes it's going to even have a low enough p-value. So like that's there, but it doesn't necessarily mean anything.
Makes sense. Makes sense. All right. Let's take a gander at the SPY again. So yeah, guys. Also, one thing. Over the next couple of weeks or so, I'm going to be, because I currently have positions on in the traditional market, I'm going to be taking those off and I'm going to be moving into the crypto market, and I'm going to be doing a lot shorter term trades. So hopefully it'll give you guys more of an idea of like what a live setup for me looks like. And we're actually going to be working on content to showcase different trading styles. Because there's virtually an infinite amount of the ways you can trade these things, but
we should just do like we had a thing. What we all love trading, and we had a thing that we would post our positions in, like exactly what Tasty does. Like when they have everyone's like they don't if they're trading, they'll mention and then like follow up. You can like, look at it in Discord, but like we had a thing. You were active there.
Yeah, I used to post charts in there. Yeah, so we have a charts section in Discord, which you guys can check out. But I do want to do some live stuff with other people and kind of talk through them, just so that people can hear it as well. Yeah, because there's a limited amount of assumptions you can make, but there's an unlimited amount of ways for you to trade those assumptions, if that makes sense. Like the tool's going to tell you something very specific, but the way that you would trade that is completely up to you. Let's see, what did I want to look at? I wanted to look at the SPY today. We are done with the first hour of the day. So we had some nice volatility in the morning. Let's take a look at a shorter time frame. Let's see where we can be going. You actually have some positive trend picking up here. You have the PEP moving down now on the 1 hour. So yeah, could get an extension here on the upside. I'd be curious to see where the day closes. I think Alice in Wonderland, are you here? Are you in chat? I think
2 minutes ago he said he has to go. He has to take a call for work.
Gotcha. Okay, maybe we'll do it before the close, but I think Alice in Wonderland wanted to go over the PEP. I still want to go over the TQC when you have some time. Does anybody in chat have any kind of questions? Anything you guys want to look at?
I'm seeing your charts, and now that I know, I'm gonna. Yeah, the thing is, I have to have the code in front to like explain it to you.
Yeah, I'm gonna be back.
It's totally my. I'm saying it's totally my bad. There's no way for you to.
Oh, dude, no worries at all. Yeah, I'm gonna be back before the day closes. So we'll definitely go over some more stuff if there's time then. So Peter Muffin is asking, DWT seems interesting. Can we go over it quickly? Absolutely, we can. Let's make sure we are on the same chart. Let's just go to Bitcoin. Let's go to daily. I remember you mentioning also something, Bali, about like how on lower time frames there's more randomness versus the higher time frames. Is that still the case?
That's the study that they did. That like it was showing there's like cost of taking trades, and that like we're not doing that. So. But like if you they measured it, and you should do it per asset per time frame. But they made it like generally you're gonna have the least amount of, and it was an entropy study. But like I think they were doing the entropy using the It still doesn't make it bullshit, but it's like some sort of it's a proxy of randomness. But the results were it's sort of intuitive. It's like the daily and like the 2 second had the least amount of noise, and anything between them was like insanely higher. So it like, and the less, you know, they talk about as randomness as it's noise that you get full, but like our entropy is way,
Right.
it tells you if the thing is predictable or not.
Right.
Like just their observation was that the least amount of noise is in the daily and the 2 seconds, so those are the best ones to trade because there's a cost of, like, this opportunity cost.
Right.
You know. So but they only did one article. It's a forex and I don't really trust their entropy. So but that was, if you went by entropy that everybody uses, which is because it's odds and it's all the outcomes and everything, they take and then they divide by the sum of the price and they treat that as odds. But like, price is not dice, you know. It has infinite outcomes.
Right.
So you know, whatever.
So I kind of wanted to go over the DWT with Peter Muffin here.
We're so insanely next level, bro, that like it's really to read, but you know.
Yeah.
The same thing with Jacob. We were saying.
So the DWT is measuring the autocorrelation in returns. Do I have that right? It's
DWT is another autocorrelation thing. So
right.
But like VRT, like I personally, I don't know why but VRT is a way better. VRT is like an epic thing, and it's what gives you reason to trade, because it tells, like, majority of the time price is a random walk and it tells you when it's.
Yeah.
You should only trade when it's not, because otherwise it's just, you know.
Right.
I mean,
so
that's not true, because you can have a strategy that takes in, you know, it's the thing that we were talking about, how much time you need for the Brownian motion to travel a certain distance, whatever. So like, but if you're trading future, you know, leverage, it's not good. So DWT is gonna, like, if you have VRT telling you,
yeah,
and then Hearst is telling you some other, trust the DWT the least.
Gotcha.
It's because they all measure autocorrelation. The literal like, they're not doing the actual autocorrelation, which is a correlation of the thing with itself with lag. They just call it autocorrelation. But one is measuring the straightness, one is length of the variance.
Yeah.
DWT is more, but if you knew which one to care more about, then if they disagree, just get rid of the one that is less important.
Gotcha. And so when autocorrelation, just so people understand, when autocorrelation is positive, if you have, for example, a positive return, you're more likely to have a positive return next. If you have a negative return, you're more likely to have a negative return next. And when autocorrelation is negative, then if you have a positive return, you're gonna most likely have a negative return next. So that's kind of what DWT is trying to describe. Whereas the VRT is telling you, okay, like, is it a random walk? Because we're assuming prices are Brownian motion, right? Like, and so it's always random. It's sometimes less random, sometimes more random. And so what VRT is trying to answer for you is like, okay, when is it not a random? When is it less random, right?
When is there statistical significant? When is there evidence that has a statistical significance that proves it's not random?
Right.
It's very hard, because it was a test to prove a point. But like, we sort of made it tradable. You don't need to have the null hypothesis fail. Like, you have to keep that in mind, that it's a very high bar, and when it's telling you it's not random, it's a passing the null hypothesis. But like, you can look at the autocorrelation. If you look at the shape before it hits the critical levels, there's degrees of how random it is.
Right.
But when it's not, it's the point of the VRT is to prove that there are areas that it's not random. But
gotcha.
We made it, same with Hearst. Hearst, we made it tradable, but people don't really use it like how we use it. But because otherwise it's just like a value, and if you look at the shape of things, it sort of make it tradable.
Gotcha. Peter, does that kind of answer it for you?
oh, I missed these.
No worries,
Yeah,
my
you
friend.
see, yeah, no, Peter, I used to say this. I used to say all the time. And VRT, I bragged about it, and that's why like VRT deserves more than the other ones. And it's like, it's confusing because it doesn't have the edit. And
Mm-hmm.
VRT is very epic because it's a very simple test. And then recently they figured it out, and it leaves no room for debate. So like all these TA people, like whoever tells you anything different, show them the VRT, and then if they still say some other shit, it's because they don't get it. They don't get the VRT. VRT like leaves no room for opinion. And it says here there's not random, and here there's enough evidence to show that. So it's just like matter of fact.
Yeah,
And then
because that's what you see a lot of traders do, right? You see them draw two lines, and they're like, okay, so because I hit this line, and it's gonna go up to this line, and that disregards that price is random. It can do anything. Like even though we have tools to measure how random, how not random, what is the distribution, how good is the trend, it can still do anything, right? Like just some things are much less likely to be outcomes than other things.
we have all these tools because we're trying to trade in areas you don't have. If you look at the VRT, on average, something about 5% of the time is when there's enough. It's just still random, but like there's enough autocorrelation that is predictable. There's predictability.
Right.
So
Or it's worthwhile taking a risk. Yeah, I was just wondering
yeah.
what else this first compares straightness.
So whether it's increasing volatility, whether it's decreasing entropy, whether it's if you're trading delta, especially if you're trading futures, you gotta make moves when the thing is predictable in the first place, right? Like the entropy or that would be something I would constantly check because if you can spend your dollar here where the thing is less predictable, why would you do it?
Right.
Somewhere where like it's like if you doing dice, or coin tosses. If the coin would have told you, hey, now I'm gonna go on a bunch of runs, and I'm more like you would always play that game, but
Right.
the price, and it's but just no one looks into it. Well, and the one that Luca made is Kaufman coding.
Yeah. So, Peter, for like what the Hearst itself is comparing, that's a little bit outside of the scope of this podcast or this stream, just because we want to show people how to actually use these things, like what would be the use case versus what it's actually made of. If you're really curious, there's fantastic papers on Hearst.
If you read the description,
Yeah.
it's like it tells you what it's doing, and it's good to read one time, but like some people can just pictorially trade it. A lot of people just get so focused on like what is it, and they never trade. Like the point of it is so you would trade it. Otherwise, like a lot of people use that like you never trade. So I want to dig into the math. It's the thing that it's if you want to be a fighter, the dude probably says what I used to tell him. It's you want to be a fighter pilot, and you don't really need to know everything about the jet and fly it. You know how to operate it. You don't need to know every single details of its engine.
Right. So Mountain Lift is saying, yes, I don't know how to use the Hearst right. I think he a little lag. I think he's referring to the Hearst. So the thing that the Hearst is trying to tell you is whether you're trending or not, whether there's correlation present. Is that, yeah.
Autocorrelation, yeah. It's so again, all you have is autocorrelation. Like the whole thing is that it's random, and then all you have sometimes is some autocorrelation.
Yeah.
Autocorrelation is a tip that like, hey man, if there is positive autocorrelation, like there's autocorrelation in price, there's autocorrelation in everything. So like for example, like when do you buy? Majority of people buy on green candles, right? So like you go, then that's autocorrelation. Like it's not the cause, but like you can go price is going up. If they say, well, why? Because it's going up.
All right.
Like price is going up. Why? Because it's going, like people see, it's like monkey see, monkey do.
All right.
Like, there's articles, and if it's doing something similar to what you're doing, it's positive autocorrelation.
Yeah.
If it's doing something the exact opposite of why you're doing, then it's negative. So like if it's when there is a mean reversion, it's going down because the thing that has negative autocorrelation to it. So, but the point is, these big moves happen when the autocorrelation adds to the moves, because the thing is like moving, and now whether it's positive or negative, when there's autocorrelation, it will move further because the correlation adds to the Brownian motion that was in play. So when it's at the Brownian range at half, you're not going to have big moves. Big moves are going to be either trends or or mean reversion in return, and then that's all it tells you. So now the value matters.
Right.
Whatever it says that there's that much autocorrelation in return.
So, Matt and Liv, this is like an example of how you could use it. I personally would recommend that you pair it with something else that's going to also tell you direction, because Hearst is not a direction tool. So there's a great example here where we crossed the 0.5 line on the Hearst. So it's telling you, okay, you're likely to be trending. And just keep it simple with like the Marxulator, you're above the mean on the Marxulator, you're positive there, right? And you could have ridden that all the way to your first red dot, which happened.
This is similar to the correlation with volatility.
Right.
Which means, like it of course it's not going to tell you like everything, because it's just telling you the correlation. But then that's just a relationship. The other two things you don't know.
Right.
So there are two things, and they have a relationship, and then that relationship is the correlation. And then it tells you the relationship, but then you have to observe the other things and then put it together. So like, of course, by itself, it's not going to tell you.
Yeah.
It's another thing that is the correlation. If you know the correlation, and then you have an assumption on this other thing, you can then apply the second assumption which would be the correlation, whether holding or reversing, and then form another assumption.
Exactly.
So that's why correlation, because you got to make whether it holds or this one holds its state, and then maybe this other thing, and even then it's only at the moment. The next second, you have no idea.
All right.
It's a big problem, and we have a big fix for it. You got to look at mutual information, which deals with probability distributions of values.
Right. All right, I think that's a good place to leave it off until the end of the day. I'm going to be back on before the market closed just to see where we landed. And yeah, go from there. I hope you guys enjoyed. If you guys can actually spam in Twitch chat, that would be a huge help, because there's this thing on Twitch where 5 people talk at the same time and it bumps me in rating. So it'll get us closer to reaching out to other people, reaching out to newer community members. It would be hugely helpful. Yeah, I appreciate you guys a lot for tuning in. Hopefully you guys enjoyed it, and I'll see you guys back here before the day's end. Thanks so much, Polly, for joining. It was much appreciated. Matador Dog, thanks for the follow, man.
Anytime, bro. Yeah, I'm gonna be back around the closest.
Perfect.
Yeah, great. Thank you.
Thank you.